For years, this creator invested most of his money into S&P 500 index funds because they were low cost, simple, and historically delivered strong long-term returns. It was considered a reliable strategy. Buy the market, hold for the long term, and let compounding do the rest. But now, things are changing. With the rapid rise of artificial intelligence, the market itself is evolving. Entire industries are being reshaped. Companies are being revalued, and investor expectations are shifting faster than ever. As a result, this creator has started rethinking his strategy, not because the old approach stopped working, but because the environment around it has changed. And that raises an important question. If the market is evolving, should your strategy evolve with it? The S&P 500 is one of the most followed indexes in the world. It includes 500 of the largest companies in the United States. At first glance, it looks highly diversified, but in reality, the structure is more complex. The index is market cap weighted. This means larger companies have more influence. As these companies grow, their weight increases, which attracts more capital through index funds, and that helps them grow even further. This creates a cycle, a feedback loop. Over time, a small number of companies begin to dominate the index. So while the S&P 500 is diversified, the influence is not evenly distributed. This leads to what is known as a feedback loop. Larger companies get more weight, more capital flows into them, which increases their growth, and the cycle continues. Now add artificial intelligence into this equation, and the dynamics become even more interesting. Many large companies are heavily investing in AI, and their valuations reflect future expectations. But those expectations must be met. If AI adoption slows down, or monetization takes longer than expected, market sentiment can shift quickly. And because these companies dominate the index, any change in their performance impacts the entire market. This is why investors are becoming more cautious and more analytical, rather than blindly trusting the system. To reduce risk, some investors are now diversifying globally. Instead of focusing only on the US market, they are investing across multiple countries. Because economic leadership is not permanent, different regions perform better at different times. Global funds provide exposure to thousands of companies across multiple economies. For example, some global funds include over 3,700 companies across more than 45 countries. This reduces dependency on a single market. At the same time, small and mid-cap companies are gaining attention. These companies often have higher growth potential, especially they adopt artificial intelligence effectively. And here's the key insight. The biggest winners are not always the companies that build AI, but the ones that use AI most effectively. As uncertainty increases, cash may not generate high returns, but it provides flexibility. It allows investors to take advantage of opportunities during market downturns. When you combine all elements together, a balanced strategy emerges. Some allocation in S&P 500 for growth, global investments for diversification, small and mid-cap stocks for opportunity, gold for safety, and cash for flexibility. At the core of this approach is adaptability. Artificial intelligence is a massive opportunity, but also introduces new risks. Smart investors do not rely on a single idea. They build strategies that can withstand changing conditions. That is what defines long-term resilience. In an evolving market,